A massive beat for Southeast Asia's largest lender. DBS starts off Q4 and full year 2022 earnings season for Singapore's big banks with a bang. Net profit came in above market estimates with a 69% on-year rise in the fourth quarter to $1.76 billion. And this was driven mainly by rising interest income as banks benefited from higher rates. Now, for the full year, net profit grew 20% to $6.16 billion. Net interest income, that rose 74% on year in Q4 to $2.56 billion. Meanwhile, net fee and commission income fell 19% on year to $497 million. And that's mainly due to weaker market conditions. Now, the group's total net interest margin, a key gauge of profitability, rose to 2.05%. And shareholders can look to a bumper payout. DBS has proposed a final dividend of 42 cents a share and a special dividend of 50 cents apiece. Lenders globally have enjoyed a jump in net interest income as central banks hike rates to tackle soaring inflation. Yet analysts warn they could suffer if higher rates lead to a sharp slowdown in economic activity. DBS CEO Piyush Gupta expects confidence to return to markets in the coming year as interest rate increases ease and China reopens. At a briefing, Mr. Gupta added that DBS has no exposure to India's troubled conglomerate Adani Group. He also does not expect any material increase in refinancing costs for the bank's Indian business unit, despite the recent attacks on Adani. Well, CNA's Roland Lim spoke to DBS CEO Piyush Gupta earlier, and he started by asking him if he feels confident about the outlook for this year.
The short answer is yes, I'm quite optimistic about 2023. As you know, 22 was benefited mostly from the rising interest rate environment. Now, if you project into 23, those conditions haven't changed very much. The full year impact of the interest rate increases done in the first half of 22 will flow into this year. And as a consequence, our NIMs will continue to increase. We do expect our top line, therefore, to continue to have the same kind of momentum we saw last year. And similarly, therefore, our bottom line, we do expect a good year. Now, the other upside to this year is post-COVID and post some of the challenges of last year, we think the macroeconomies are beginning to be a little bit better in our part of the world. Now, I say this carefully. It's quite clear that in the West, you will see a slowdown this year. But even there, things are not going to be as bad as we originally predicted. I think the US might escape the recession. So our current call is close to a percentage point of growth. We think Europe might also escape a recession, maybe 0 to 0.5% of growth. And on this end of the world, China's opened up quicker than we expected. And therefore, we think the Chinese GDP could do north of 5% this year. And as you know, when China grows, then certainly all of Asia benefits, let alone the rest of the world as well. So we think there's some upside that might come from that. The uncertainty this year is really going to be around the impact of the global slowdown, and does it result in higher cost of credit? So for the time being, I'm relatively sanguine. I'm not seeing a lot of stress anywhere in the system or in the portfolio. But to be fair, it's still early days. We'll have to watch through the rest of the year.
Okay, so optimistic but sanguine at the same time. The US Fed expected to hike rates up to 5% this year. Now, this is an environment we haven't seen before. Is this likely to temper inflationary pressures?
I think inflation is already coming down. If you look at the CPI rates, which the US Fed tracks, they're already down to the 6 handle from 8. And just based on the base year effect and based on low energy prices in Europe, it's quite clear that you will wind up with an inflation rate of circa 3%. In fact, the big question is, do you wind up in the 2.5 to 3 range or the 3 to 3.5 range by the end of this year? So I think inflation will moderate. The question is really, at 3 to 3.5% inflation rates, does the Fed start relenting? And I don't think that will happen. I think one of the lessons the Fed has taken away from the 1980s phenomena is you don't want to wind back too early. So my personal prediction is that they will hold rates at the 5.25 range, whatever they get to, and hold rates pretty much there for the rest of this year.
So likelihood is that Asian central banks will also take their cues from the Fed.
I suspect Asian central banks might start easing before the Fed starts easing. Because for many of the countries in Asia, the dichotomy or the dual mandate of growth and inflation is tricky. So I would not be surprised if some of the Asian central banks start easing before the Fed starts easing.
Rising interest rates is a negative for SMEs as well as for everyday consumers here. Are you seeing less demand for loans, for credit card fees, for example?
Well, interestingly, so far, no. There was some slowdown in loan growth in the fourth quarter. In fact, we had negative loan growth, but it didn't come from the SME segment. It was really the large companies who had cash on hand and could use the cash to repay high-cost borrowings or had the ability to go to other geographies for cheaper source of funding. The SMEs, we did not see a significant reduction in their borrowing through the quarter. Similarly, on the consumer space, we're beginning to see some impact in mortgages. The mortgage bookings for the fourth quarter of this year were half what they normally are. And that's a mix of both things. The policy tightening actions which were done in September, plus the higher interest rates. So you're seeing some impact on demand in the mortgage sector.
The bank's non-performing loans is, of course, on analyst watch list. You managed to write down some of that. But going forward, is there any impairment of losses, particularly with all the COVID loans that were dished out last year, the year before?
Actually, not seeing that. Our NPAs have come down from 1.5% all the way down to 1.1 at this point in time. And as you can see, every quarter we wind up having to reverse general provisions because of an improvement in the underlying portfolio, upgrades, people are paying us back, we're getting shorter tenors. And so we're not seeing any of that. Now, the COVID relief packages as well, a large number of them have moved from COVID support to normal borrowing. And again, we're not seeing any pickup in stress or delinquencies in that portfolio either.